Hi all, welcome to the first of a new series, Finance in 5, where I talk about finance issue or topic in 15 minutes or less, giving you a quick snapshot and hopefully some fun financial facts and insights. This video, as you'll no doubt be able to see from the title, is on stock pitches. More specifically, I'm going to run you through a potential stock pitch, both the layout and the content, for this example, Netflix. As ever, this is not supposed to serve as investment advice or as the basis for your own investment decisions. This is just one guy's take and is as much net facts as it is net fiction. Stock pitches can often be used in a professional environment or interview settings where you might be asked to pitch a stock as part of a recruitment process. So when it comes to the first section of a stock pitch, arguably the most important part, the recommendation itself, we are recommending whether or not we are taking a long or short position on the stock in question. Long being holding an existing investment or investing more into the company, and short being, well, in short, where we advise investors to sell their shares with the intention of repurchasing at what we believe will be a lower price in the future. In the case of Netflix, we suggest taking a long position, which would mean buying the stock as we perceive the stock is currently undervalued and therefore the value will rise in the future. Of course, I'm sure we are all familiar with Netflix, and if you aren't or haven't seen the likes of Ozark or Stranger Things by now, you're missing out big time. Ozark in particular has a fantastic balance of financial advice in the form of money laundering as well as speedboats, so what's not to like? In short, Netflix is a streaming and production platform offering purchased and increasingly more original content to audiences on demand. The company has an estimated 220 million subscribers and had an all-time high share price of $700 at the end of 2021. The company has a market cap of 84 billion, meaning that all available shares to date are worth this amount. Netflix 2022 Q1 revenue, so that's the revenue from January to March of this year, was 7.87 billion, which was a 9.8% increase on the previous year. You might now be wondering why Netflix shares have plummeted then if their revenue has been continually increasing. Well, their Q1 earning reports highlighted their subscriber growth rate had begun to slow, suggesting a potential tail off of future growth. A further reason for the falling share price is the current recession risk that looms over the global economy. This has led to a global sell-off of tech stocks in the past 6 months, as they are more susceptible to the impacts of a recession. The investment thesis section of a stock pitch sounds a lot fancier than it actually is. Effectively, it is just your justification for your investment decision, in this case why we feel Netflix is a good long option right now. The thesis for this pitch is relatively straightforward. In recent years, Netflix has been heavily overvalued as it had a dominant share of the streaming market and a considerably high subscriber growth rate. However, in recent years, the emergence of Disney Plus and other streaming platforms has led to a stronger competition in the market. That, coupled with a lack of faith in tech stocks in the market at the moment, has led to the large overcorrection of Netflix stock price, leaving it now what we deem as significantly undervalued. This dramatic fall will, we believe, lead to an equally dramatic overcorrection when Netflix report their Q2 earnings and investor confidence begins to rally again. Furthermore, Netflix's current and continuing success in penetrating new regions and customers will invigorate subscriber growth, meaning, as of right now, they are undervalued. Catalysts of an investment recommendation are the events or activities that will cause the market to realize the pricing of Netflix being undervalued, leading to the long position paying off as their stock price rises. In this instance, one catalyst will be the impact of Netflix increasing their subscription prices. This recent move has garnered them a considerable amount of bad publicity on social media. However, as inflation looms large on the market, Netflix's price increase prepares them well and effectively makes them resilient to inflation in the future. Although this could be seen as a preemptive move, ultimately this can favor Netflix in the long run. It is important to highlight the current value of the company which your stock pitch is focused on and how it is either currently under or overvalued based on your recommendation. One popular valuation method is the price to earnings to growth ratio. It is a company's stock price to earnings ratio divided by the growth rate its earnings over a specified time. One article mentions that Netflix currently have a PEG rate of 1.54, making the streaming giant fairly valued relative to its industry peers who share a median PEG ratio of 1.61. Also, in the March quarter, Netflix earned $3.53 a share on sales of $7.87 billion. Wall Street had predicted Netflix earnings of $2.90 a share on sales of $7.93 billion. On a year-over-year basis, earnings fell by 6% while sales climbed by 10%. Ultimately, investors have focused on the company's first drop in subscriber rates in over a decade, which they believe is the true indicator of the value in the streaming service. Risk factors. Obviously, like with any investment decision, there are risks. The market may not react how you expect, and you could always end up getting burnt. With any stock pitch, it is important to highlight the market and company risk factors that could affect this prediction. First major one being the recession risk that's already been mentioned. leading to an increased cost of living. In this case, the demand for the streaming service could suffer altogether as customers begin to prioritize other elements of their spending. The next element would be if after the Q2 earnings, subscriber growth rates continue to dwindle. This would lead to a further tumble in stock price as investor concerns are realized. Finally, the growing influence of new, short-term, digestible media such as TikTok and Instagram Reels that are becoming increasingly popular in younger generations pose a potential shift in consumer preferences away from longer series and films and instead focuses on shorter content. If Netflix is unable to compete or perhaps incorporate this form of content going forward, they could be losing out on a generation of future users of the streaming platform. Ultimately, Netflix have suffered at the hands of its own success in recent years. Continually amassing subscribers year on year at such speed has led to them effectively running out of existing customers to target in their primary regions. The recent price fall has led to them becoming undervalued compared to their competitors. That's been Finance in 5. I hope it was interesting and that maybe it will prove helpful if you ever have to create your own stock pitch in the future. Thanks for watching, and remember that this is just one interpretation of Netflix's performance and is by no means a certainty for what happens next to the streaming company. Feel free to let me know if you think Netflix is over or undervalued in the comments, or let me know what you thought about this stock pitch.